We will be starting the webinar shortly. As attendees are joining us, I would like to say hello and welcome to our virtual coffee talk from pandemic to recession. Are you salt ready? Before our webinar begins today, I would like to go over a few housekeeping items. In case you did not know, you can earn 1 CPE credit by attending our presentation today. To receive the credit, you must stay connected to the webcast for the entire presentation and participate by responding to at least 3 of our interactive questions. You will receive an email within 2 to 4 business days with instructions on how to access your CPE certificate. We also invite you to complete the course evaluation that will occur at the end of this webinar. We appreciate any feedback that you give us. And with that, I will turn it over to Kevin Jacobs of Alvarez & Marsal. Over to you, Kevin.
Great, thank you. And thanks everyone for joining. I'm really excited for this month's virtual coffee talk. And I know I say that, but this is actually our first SALT specific coffee talk. And I've heard in speaking to a lot of people, hey, when are you going to address SALT? And well, here you are. So joining me today are my colleagues from Alvarez & Marsal, Gina Pizzo and Brian Peterson, who are managing directors who focus on SALT, as well as Maria Todorova from Eversheds and Sutherland, as well as at the end of the presentation, as always, we'll be hearing more from Wolters Kluwer on how to use Answer Connect. And this month we're joined by Jessica Arnold. So definitely stay tuned for that. As you could see on the agenda, it seems like a really short, brief agenda, but I can assure you that this is a very ambitious agenda, and there is a lot going on here. We're going to talk about, the post-pandemic, what are we seeing from state and local tax trends, as well as what are we seeing from tax audits? And that is actually 2 different things. You'll see how they sort of come together, but also it's really important to keep in mind, what do we think is going forward, which will lead to our last topic, which is going to be the best practices for preparing for the future, noticing potential new taxes, recession, and of course, what presentation thinking about the future would be complete if we also didn't talk about bankruptcies. And so with that, we're actually going to launch into our first polling question to get it out of the way. And that is, have you seen an increase in state audits since 2020? And so just as a mindful reminder, you do need to answer the polling questions in order to get CPE credit. It should be launching on your screen now. While that is launching, being mindful of how much we want to cover, Maria, do you want to start talking about the post-pandemic SALT trends and what we're seeing? Maria, I believe you're on mute. No, I believe you're still on mute. I guess while Maria's trying to work on the SALT trends, I know, Gina, you had some thoughts on some of the trends that you're observing. I don't know if you want to chime in while we're waiting to see how to resolve Maria's technical issues.
Sure. Thanks, Kevin. Can you hear me? Okay. Yep. Okay, great. Well, I think, sort of the single biggest trend that.
Yep.
Oh, there we go. There we go.
I'm so sorry. I don't know what happened, but I apologize for that technical difficulty. And I was just saying that, I'm happy to be here, and good morning, good afternoon to everyone who's able to join us today. And so what we wanted to do today, as we've been reflecting on what's transpired and what we have endured over the past 2 years and where we're heading, we kind of have like we're at a very interesting cross point because that started with 2 years ago with the pandemic and what's happened since then, and now we're kind of starting to feel the recession already. And how do we, based on what we're seeing now, how do we prepare for what's to come? And even looking back to some 10 years ago when we dealt with the Great Recession. So the purpose of today's presentation is to really just cover some of what we're seeing as far as SALT trends. And some of these trends, as you could tell based on the slide, are they're not new. Some are just kind of what we've been dealing with over the years, but maybe from a different angle. And some of them are completely new challenges. So, and new matters, new issues. So starting with the digital advertising taxes, you guys know, or most of you I'm sure know, that Maryland was the first state in the country to enact a digital advertising tax. And these are, kind of a different animal, if you will. These are not, we all know about, income taxes, gross receipts taxes, sales taxes. These are gross revenue taxes. And so they are, targeting, I think Maryland's been fully transparent, they're targeting big tech. And there's been a lot of activity, a lot of attention to these digital advertising taxes in the whole world, in fact. And so I think Maryland was the first one to just, pioneer the first US-based digital advertising tax. And there's a pending challenge that, before in Maryland, but in state court. And the main issues, without getting too much into the detail, are constitutional issues, whether these digital advertising taxes violate the Commerce Clause, which, I think we would all agree that they do, just on the face of the statute, because they establish these sort of dual standards or thresholds for how the tax would apply. And whether there's, they also violate the Internet Tax Freedom Act because they discriminate against companies that provide advertising over the internet versus companies that provide sort of the more traditional advertising, are not subject to the tax. So, we just wanted to mention the digital advertising taxes because we have seen an uptick in great interest from various states. We saw proposals in New York, we saw proposals in Wisconsin, we saw proposals, I think, a number of other states, and the tax rate in Maryland is 2.5%. But the proposals that have come through from other states, have contained, tax rates in the ranges of 10%. So it's a pretty significant revenue generator, and I don't think these digital advertising taxes are going anywhere. So all eyes are on the state tax, on the matter that's pending in Maryland, which my partner Jeff Friedman is kind of handling that case, and it survived a motion to dismiss which the state had filed. So we were very excited for the case to proceed. So I think more to come on that, but just I'm seeing, I don't know about you, Gina and Brian, but I'm seeing a lot of clients kind of gearing, a lot of companies getting ready and preparing just in case, what happens if these taxes become more prevalent.
Yeah, I've seen that as well. And, even trying to determine what revenue streams fit under the taxing scheme is difficult enough, let alone sourcing the revenue for purposes of the tax.
Exactly. I think that Maryland just kind of put the cart before the horse, right? And the tax became effective before all of those nuances that Brian just mentioned were flushed out. So I think even if as states are proposing these taxes, there are a lot of issues in terms of, how do you actually compute your tax liability. The next issue just wanted to mention that we're seeing a lot of activity is in the context of the Internet Tax Freedom Act. And, you might know that the Internet Tax Freedom Act was actually put in place. It's been around for a very long time. So it's not a new phenomenon, right? It's been around since 1998, and it placed a moratorium on, let's just say, transactional taxes on internet, state and local transaction taxes on internet services. It was intended to promote the development of kind of the internet infrastructure, broadband, et cetera. So it's been around for a very long time. It kind of went through a few amendments, as far as at first some states were grandfathered, so they were allowed to tax internet. Some states were then ultimately, there was an issue: does it apply to what portion of the service does it apply to? Does it apply to the backbone or just the internet service? So we are now sitting in 2022, and this Internet Tax Freedom Act is now permanent. Initially, it had an end date, and so it's permanent. And for folks like me who have been dealing with the Internet Tax Freedom Act my entire career, when we see permanent, how many issues could there potentially be? Well, you would be surprised. So the Internet Tax Freedom Act contains a very important provision that essentially prohibits discrimination against commerce conducted over the electronic commerce over the internet, or and so now that everything is becoming electronic, ITFA has become even that much more important. And so what we're seeing from a number of states and localities is they're taking these novel positions that, especially in the context of gross receipts taxes, or taxes that are kind of like the privileged taxes for doing business. The states, like for instance, in Virginia, the localities are taking the position that their business, professional, and occupation license tax, which is basically your local gross receipts tax that every locality enforces in Virginia, they're really tax on the business, and not necessarily a tax on the services they provide, or the commodity that they provide, and therefore they're claiming that they're exempt from the Internet Tax Freedom Act. And so that is a huge leap for the states to be making, and we're seeing that in Pennsylvania. We're seeing we're seeing that in a number of other states. So that's just something to pay attention to.
Yeah, Maria, I would agree, and I think a lot of what's causing the Internet Tax Freedom Act issues are the proliferation of digital products, digital services. 10 years ago, no one had ever heard of software as a service generally. And now, like every day, we're dealing with that. So it's again, you're right. It's one of the trends over the last 10 years.
Absolutely. Yeah, absolutely, Brian. I think to your point, I mean, Texas just issued a ruling, right, that says, well, we're going to tax online storage, right? And so even though storage in a more traditional way is not taxable, and so again, does that create an ITFA discrimination issue? I would argue it does. So I think it's definitely something to pay attention to. PL 86272, another archaic law, right? I mean, PL 86272, it was enacted in 1959, so I can't believe we're still talking about that. And it was supposed to be temporary, but of course, we're still relying, or a lot of companies are relying on PL 86272. It's intended to protect sellers of tangible personal property from imposition of income taxes outside of their home state, so long as their activity is limited to the solicitation of sales. And so I think states have never really liked 86272. So over the years, they have tried to sort of kind of chip in, one effort at a time to try to minimize the scope of 86272. And so the reason why we wanted to bring this up is there's been a lot of activity in the last couple of months even that really stemmed from that guidance that the MTC issued in 2021 that was really intended to limit any protections of 86272 when it comes to activity that takes place electronically, right? And so to Brian's point, as we, have predominantly kind of switched into this global space, the metaverse, whatever you want to call it, the electronic space, I think, the MTC is really trying to encourage states to amend their guidance as far as, okay, what protections could taxpayers get under 86272? And if you read the MTC's guidance, I mean, it really doesn't leave that much on the table at all. And so after MTC issued its guidance last year, California, maybe a couple of months ago, decided that they're going to provide a guidance that largely mirrors what the MTC says, and New York issued final proposed regulations, which I believe are going to become, comments are due at the end of this month, that essentially, it kind of sets a really troubling trend that extends, sort of the state's ability to reach out of their borders and say and claim that you as a company are doing business in the state just because you perhaps, I think California said if you have one employee that's telecommuting from California, that disqualifies the company from any 86272 protections. So if that's something that you rely on in your kind of filing positions, I would certainly kind of, go read those pronouncements that California and New York have issued, and I think more states are to come.
And just to chime in, I know that there's a lot on the slide, and as we talked about, there's an ambitious agenda. Why don't we turn a little bit to the aggressive positions on services? I know, Brian, you started mentioning the SaaS, but I'm sure the audience wants to hear about that as well.
Yeah. No, I'll take that one, Kevin. Thank you. And I guess just to level set, I think we would probably be remiss to not give a backdrop of the overall impact of the pandemic, right? When we start talking about individual jurisdictions, the reality is all of them were significantly impacted by a decline in revenue, and specifically the larger jurisdictions, right? New York, California, Florida, Illinois. Texas, unfortunately, was hit with a double whammy because it was the pandemic in conjunction with the oil price collapse. So you're talking, between 25 to 75% decrease in overall revenue. So what does that mean from a state perspective? And how do they move forward with trying to regenerate that revenue? Well, unfortunately, the answer is to expand the tax base primarily on services, but also to take some fairly aggressive positions, which we've also kind of alluded to earlier in the presentation as it relates to SaaS, info, data processing. And one point that I want to make, and Brian touched on it earlier, is, a lot of times the corporations or the companies that we work with, when you talk to them about what is it that they do, they say we sell software or we are a staffing service, right? And at the end of the day, anyone that's practiced in the state and local area understands that there's typically 8 to 10 sales tax attributes that can be characterized for the one stream of revenue that they think they have, right? So to Brian's point, really what's key and what we found to be most advantageous for most companies is to really understand how your revenue is allocated into these different attributes and how the taxability would be impacted as such. And by that, I mean, is it just SaaS? Or does the fact that they're manipulating data now roll you into a data processing service? And the fact that they're transferring information, are you now, morphing into information? And the fact that they transmit it electronically, are you now moving into telecom, right? So understanding how to characterize the revenue appropriately on the front end is extremely helpful in terms of minimizing the risk and understanding the existing statutes in the various jurisdictions.
Hey, Gina, I have a question. So would you agree that one of the biggest challenges in that area is a lot of the companies want to present themselves as a one-stop shop for a lot of different things? And some of those things looked at discreetly might be taxable and some might not be taxable. But the fact that they're not breaking those down in terms of what they're selling their customers, they're giving them, for one rate, you get all this, makes it a bigger challenge to figure out exactly what they're doing and how to tax it and source it.
That's exactly right. And I know that we're going to get to this in the next couple of slides, but that's specifically what we're seeing in the M&A space, right? Primarily with middle market private equity companies, we're seeing, an increase in issues surrounding characterization of the revenue because they want to simplify their company for the purpose of exit, right? But at the end of the day, these risks still exist and they need to be addressed. So I don't want to spend a ton of time on it, but I think the short story is, as a result of the decline in revenue, the normal response from the states is to increase the tax base and try to figure out a way to get some of these newer services incorporated.
Yeah, I mean, I think that's a very good point. And I think, Gina, it's so interesting, right? Because I think if you kind of backtrack a little bit and trace history, right? When the pandemic started, we were all panicking and the governments, state governments and local governments were panicking. And then everybody started buying stuff online and, just sitting home and producing all that revenue. And so a lot of states actually came up, they were flush with cash, right? Everybody was exceeding budgets. And now, to your point, I think that's kind of changing, right? And so states are already seeing reduction in revenue. And as we're heading into a recession, I think that's, unavoidable in my opinion. I think that trend's going to continue to grow. And so, it was interesting, for instance, this time last year, right? I mean, everybody was reporting excess of billions of dollars in state revenue, and not necessarily at the local level. I think the locals were still struggling just because they're just in a different bucket, right? But a lot of the states had excess revenue, and so it was maybe perhaps states in the past might have not been willing to talk settlement, or might not have been willing to have kind of negotiations about certain positions. We saw a little bit of a change there. But I think to your point, we're going to see sort of we're seeing already the comeback of these aggressive positions. The states are now sensing that revenue is quickly going to go away.
Kevin, should we head to the next slide?
Yeah, we can do that. Gina, you want to touch on some of the Wayfair challenges?
Absolutely. And I know that probably the majority of the people on this call are very familiar with Wayfair, so I'm certainly not going to go through the historical timeline of the Wayfair decision. That said, what I do think is important to point out is that since June of 2018, every state that has a sales and use tax has in fact enacted an economic threshold, if you will, as a result of the Wayfair decision. And what does that mean? Well, it means that compliance has become quite a nightmare for everybody, not just the large corporates, but every company that has a presence anywhere is significantly impacted by this decision. To make things even worse, as we all know, every state has interpreted it differently and created different thresholds. So on top of the fact that you've now got essentially an immediate increase in Nexus footprint in multiple jurisdictions, you've also got the daunting task of trying to figure out what the thresholds are in that respective jurisdiction, right? So, most of them are dealing with the revenue and a number of transaction threshold, but when you get into the revenue side, it could be gross sales, taxable sales, retail sales, related party sales, and how do you define that? And how does the state define that? And how do we as individual practitioners in a tax department advise our clients to handle this nightmare of an event? In addition to that, you've now got the tracking of the thresholds, right? If it's measured annually, when does the period start and end? What about tracking when you no longer have the threshold? How long do you do it? What are the locals doing, right? Are the locals following what the state's doing? Probably not when you're dealing with home rule jurisdictions like Louisiana, Colorado, and Alabama. So the short story with Wayfair is that, yes, it's a compliance nightmare. What are we seeing in terms of the market? We're certainly seeing people invest in technology to streamline the compliance aspect of it. But more importantly, where we're really seeing significant issues, and I know, Brian, you and I deal with this probably on a daily basis, is the impact in the M&A space, and specifically how it's impacting deals and their ability to move forward. I think we mentioned, typically in the private equity space, individual companies are in a growth strategy, right? They're looking to exit in 3 to 5 years or 5 to 7 years. They're not overly concerned with sales and use tax until they need to be. And that's happening fairly regularly, right? I mean, I would say that probably about 9 out of the 10 deals that I review do in fact have a sales tax issue. And so what does that mean? What it means from the corporate side is that if your company is going through a transaction, you need to be up to speed on what the potential risks are. You need to have a general understanding of what the engagement and the purchase price agreement indicates. You have to understand whether the escrow has been valued correctly and whether the indemnification clauses are advantageous to you as a buyer. But most importantly, you need to develop a plan and a strategy to remediate any potential risks that have been identified. And that's where we're seeing a ton of action and activity is, quite frankly, okay, the deal has occurred. Now we've provided some sort of 12 to 18 month, escrow period to resolve it. How do we move forward with remediation? And how do we put that into action such that we're minimizing risk prospectively? So we're helping clients a lot in that space. It can be a number of things. Obviously, VDAs would come into play here. You could register and collect without doing it. But at the end of the day, what you want to be mindful of is that in the next 5 to 7 years, when you flip the company or exit, that this issue is under wraps because it progresses fairly quickly. And as we all know, the penalties and interest add up very fast. I don't know, Brian, if you wanted to add anything about sort of your M&A experiences.
I do want to add one thing, and I thought, Gina, you covered that beautifully, but I think that, this isn't limited to Wayfair. It relates to economic nexus, period, both for income tax and sales tax. A lot of what's happening lately that I've seen after foreign companies for both income tax and sales tax. A lot of people think, well, if there's a treaty between the US and a foreign country that precludes federal taxation, that they're okay from a state tax perspective, and that's not accurate. Treaties generally have nothing to do with whether a company has nexus or not. So it's quite common for a company to be protected under a treaty because they don't have a physical permanent establishment in the US, but they do have nexus principles. And one of the issues with economic nexus for income tax is over the last 10 years, there's been a markedly strong shift to customer location to source services and instead of cost of performance. And so a lot of companies have subsidiaries overseas that do engineering services or customer like call centers, et cetera. And those, if they have sufficient clients in the US, which would be their parent a lot of the times, that leads to an economic nexus determination, and the foreign company itself could have a major state income tax or sales tax problem. And states are going after this more aggressively. We've seen California, for example, as part of an audit, ask when they do their IDRs, they literally ask a company, what payments have you made to your foreign affiliates and for what? And they're looking for service payments. They're looking for payments on goods and services that might be subject to sales tax as well. So that's something that's getting a lot more attention over the last few years.
And just to interrupt, while you were speaking, Brian, we launched our next polling question, which is, well, enacted income tax cuts lead to future budget shortfalls, stimulate economic growth? Don't know. Obviously, what we see on the federal side has potential implications on the trickle-down effect at the state level. So I guess while we're waiting, Gina, can you start discussing with us what you see as the evolution of SALT tax audits?
Sure. Yeah, I'm not sure that there's necessarily been an evolution. At the end of the day, the state and local tax audits have continued to occur. I think that what's most important post-pandemic is we've seen significant delays at the rate at which these audits are performed. And I think there's a number of reasons that directly relate to that. Primarily, COVID and remote working was obviously putting significant delays in the ability for those audits to get completed. That sort of coupled with your corporations really becoming very lean in terms of their tax departments, scaling down, downsizing perhaps, that coupled with sort of the state's lack of movement was resulting in audits that were going on seemingly indefinitely. In addition to that, you're also having sort of a mass exodus of experienced auditors leave the state, again, for various reasons. Lot of retirement, a lot of people were offered retirement when COVID hit to take it early. But the biggest issue that we've been seeing is the competitive market right now, right? And their ability to leave the state and make more money elsewhere. Everybody's essentially jumping ship, no pun intended. And what that results in is inexperienced auditors with significant lack of industry experience. All of those things coupled together result in very long audits and increased litigation. And what does that mean for the company? It means you're pooling internal resources that would typically not be performing these audit functions now. In addition to that, you're signing additional waivers, potentially compounding penalties and interest because these things are going on indefinitely. And now also paying the litigation costs to try to resolve these audits. So I know that, on the next couple of slides, we're going to talk about best practices, but I did want to point out on this particular slide, some of the states that have been notorious for increased audit activity, but also unrealistic audit activity. I mean, these states are not going to be new to anybody on the call, but I will point out, Pennsylvania, and Maria, you mentioned Pennsylvania in the first slide, they have been an absolute nightmare to work with on just the basic audits. And, I can give a quick example. We're working with a very large fracking company in Pennsylvania. I don't want to get too industry specific, but the reality is nothing that this company does is subject to tax in Pennsylvania, not on the sale or the purchase side. And the state has taken the position that they want to look at, $300 million worth of fuel purchases because 0.5% may actually be used in a taxable manner. And they want to audit, receipts to Applebee's because perhaps the tax was charged incorrectly. So it's just ridiculous requests by states, which again, you have to be on the defense. If you don't address it early on and immediately ask to go to supervisors or the Board of Tax Appeals or whatever, you're going to be dealing in this vicious cycle for, up to 24 months, which costs companies money if they've hired consultants, or, right, it takes away from their internal resources. So I think the short story here as it relates to audit is be proactive with your audits. And more importantly, if you have multiple audits going on in different jurisdictions, develop a tax strategy for how you move forward. Be purposeful, right? If you have 15 audits, but 70% of your dollars are in the top 2 audits, those are the audits you need to focus on, right? We can look at settling those lower dollar ones, but put together a strategy so that you are in control. I would encourage those that can to provide the state with timelines and also indicate that they're not going to be signing waivers unless it's a mutual agreement, right? Because what would happen is, because of these lack of resources, they continue to kick the can down the road, and now you're 24 months into an audit just waiting on data to be provided. So not sure if anybody else wants to chime in here, but again, the takeaway is when you have the ability to control the narrative, you should do so. I would encourage upfront meetings with the state to develop these timelines and also to indicate what your company's position is with regard to this audit. And more specifically, I don't want this to exceed 12 months, so we're gonna pause.
I would say one quick thing I would say is what I've noticed in several states, Washington probably being one of the worst, is given the digital nature of a lot of transactions these days, they're starting to say, well, your books and records don't reflect the treatment that you're trying to argue for. And even though it's industry practice, and even though it's how everyone in the industry does it, they're trying to fall back and say, well, you need an invoice for every transaction, otherwise you can't prove your case. And that's going to be a bigger and bigger problem because of so much more of our business is conducted digitally. And we don't necessarily have ledgers to look at. So again, it just goes with what you said, Gina.
Yeah, I wanted to make a couple of points. I think that, Gina mentioned that we are just truly lacking industry experience. And, it's truly fascinating to me that, for instance, handling transfer pricing cases. I mean, the subject matter is already too complex and states are way behind the feds as far as education, as far as just understanding how the transfer pricing rules work. Although there was a concerted effort led again by the AMTC to invest resources. We saw Indiana do it, we saw other states do it, and try to educate the auditors in transfer pricing. And now those auditors have disappeared. And so I end up doing a lot of education, working on transfer pricing audits, to try to explain to them how the rules work. And sometimes I'm successful and sometimes I'm not successful. The other point I wanted to make is something that Gina said. I think strategy is extremely important because it's very likely that you don't have that issue in just one state, and states are talking to each other. I was doing discovery, and during discovery, I find, a state auditor sending an email to a neighboring state auditor saying, hey, look what I just found auditing this company. You might want to go and investigate because that company was doing business in that neighbor state. So states are definitely talking to each other. So you want to be consistent as much as possible, understanding the laws differ, and so you could have different interpretations, but consistency is really important. And I think it kind of goes back to that, having a strategy from the beginning, a national strategy that you're consistently applying, taking the same or a consistent position, not the same, consistent.
So we've all heard from Gina, Brian, Maria, that there's aggressive positions being taken. We launched the next polling question, which is, for which tax do you think states are taking the most aggressive position? Income, gross receipts, sales, property, or other? And while you're filling that out, Maria, why don't we start discussing the best practices that they should be implementing for preparing for the future?
Yeah, absolutely. And I think this is just really wanted to summarize what we have been talking about for the past, 30 some minutes. But I think really planning ahead is crucial. Not, the point that I just made about developing a national strategy so that you are able to defend your position in multiple jurisdictions, but contemporaneous documentation is extremely important. And I think Brian alluded to that fact, that there's going to be challenges, right, because of the way we do business now. But to the extent that there is contemporaneous documentation and that could be put in place, it's extremely important. And I think as we companies have become so global, and there's a lot of, for instance, in a company activity happening, and just not to pick on Washington, which is truly one of the worst states with one of the worst. It's really because they have the most egregious tax, right? The B&O tax that should be just
abolished.
That was like abolished, exactly. I was looking for the right term. But it's truly, the Washington's particularly, I mean, their demands for documentation and, asking for the ledger and then all these financial documents, even though you're not required, for instance, to have separate financial documents for each and every separate entity in your structure, because the federal rules don't require it. So I do believe that having this contemporaneous documentation is only going to benefit you in the in future audits. Keeping track of what's being provided to the auditors is really important, because it's oftentimes auditors are gonna, especially because they're lacking resources, and as Gina pointed out, everything's taking extra long, and so oftentimes, when auditors are running out of time and you're not willing to sign that waiver, they might issue a jeopardy assessment and point the finger to you and justify themselves, before the appellate division and say, well, the taxpayer didn't give me the documentation and therefore I had to do X, Y, Z. And so it's really important to have that memorialized in terms of like what's been provided, so you can just show that estimated or jeopardy assessment is not warranted. Balancing compliance, with the taxpayer rights. So this is something that it's really important. I think in some states, I think Florida actually, I don't know if you guys have seen this, but a couple of months ago, they actually enacted legislation that provides that if certain information is not provided during audit, it cannot be used as evidence later in the controversy or the litigation of that matter. And that's extremely important. And it goes back to at what point in the process does the record get set? And, there's been reported decisions in New Jersey and Ohio where that's become an issue where, the states have asked for certain information. And, we struggle with this, right? Because, why do I have to give you a 50 states study? Why do I have to give you information on, what do I do in my entire footprint? So it's really important to determine, kind of think ahead. It's almost kind of like playing chess, okay, what is going to be my move 5 steps down the road and what information I'm going to need to prove my case.
Hey,
oh yeah, sorry.
I was just going to chime in real quick because I'm just want to be cautious of time. I know we're 11:38 and we have one more slide, but I think the single biggest piece of advice that we can provide as it relates to best practices for audit is audits are a repeatable process. And when you have a repeatable process, you can automate that, or you can develop internal processes so that you're not duplicating the wheel, every single time you have an audit. So to your point, these are steps that occur every time. There's initial upfront data, there's strategy planning, there's timelines, there's execution, there's specific reports that are going to have to be run within your ERP system and your cool bolt-on. Get those things, work with IT, they're going to be your friend, work with IT to get some of this stuff streamlined so that you're not recreating the wheel every time you get an audit notification. That's going to help your internal tax department significantly move through these things much more swiftly and efficiently, and hopefully with a quicker result.
Yeah. And one other point before we move on to the last slide, I think it's, I think confidentiality, particularly when they're third parties involved. So a lot of localities use contingency fee auditors, and also we're seeing states resorting to experts, for instance, in the transfer pricing arena. They call them experts, right? That kind of generate these assessments and that are overstated. So just pay attention, just because, it happens all the time. New York, right? I mean, they're using third parties for property tax purposes, for instance. And so just make sure that the necessary protections are in place such that, the information you're providing doesn't end up in somebody's hands that's not subject to confidentiality restrictions.
Before Brian starts talking about bankruptcy and restructuring, I did want to chime in. One of the things that we talked about on a former virtual coffee talk was ESG, and we highlighted how you interact with the state taxing authorities as well as federal and international is part of your ESG plan. So when being mindful of all of the aggressive positions that states are taking, as well as the automation and the planning and strategies that Maria, Brian, and Gina are suggesting, you have to be mindful of the overarching impact, the tax transparency, and the plan that the company is taking and planning to implement, and your relationships with those taxing authorities. And so it really is this fine line balance of trying to make sure you're what people view as a good taxpayer or a good corporate taxpayer, while also making sure that you're only paying your fair share, right? And you don't have to pay more than that. And so it's this really fine line that people have to walk, and that's why we're trying to encourage you to really start thinking about how you should best address these situations. But with that, I guess, Brian, if you want to talk to us about what we should know about bankruptcy and restructuring readiness.
So let's say we are heading for a recession. Worst case scenario, there's a bankruptcy involved, right? So the rules in a bankruptcy are very particular, very specific, but almost counterintuitively to the tax professional, bankruptcy offers a lot of advantages over dealing with jurisdictions in the normal course of business. Specifically, there's a way in a restructuring, a debt for equity swap, the cancellation of a debt of indebtedness income doesn't apply in a bankruptcy. It reduces attributes in many cases, and then if there's excess CODI, it goes into a black hole and disappears. There are different rules for particular types of gain recognition in a bankruptcy and tax attributes. So tax attributes such as NOLs, credits, etc., are impacted by the amount of debt that's restructured. And so oftentimes you can emerge from bankruptcy with reduced attributes. Having said that, 382 does not apply in a bankruptcy. So ownership change rules limiting the use of NOLs going forward may not apply depending on how the bankruptcy is structured. So it enables a taxpayer to avoid CODI income in many instances, also enables them to preserve some attributes going forward that would otherwise be limited in an ownership change when the creditors become the new shareholders. It's important to know that not all debts can be discharged in a bankruptcy. So we need to understand in terms of tax debt where they fall in what we call the waterfall in terms of the creditors, lien holders, secured creditors, unsecured creditors. Typically, tax claims are unsecured claims, so they come behind the secured lenders, but they're priority unsecured claims. So they generally come before all other unsecured claims, which leads me to one of the advantages we have in bankruptcy. Oftentimes, in order for a taxing jurisdiction to be able to be paid for a period of time that's before the filing date, they have to file a claim in the bankruptcy against the taxpayer. Oftentimes, states file what they call protective claims and what I call pretend claims. They make the number up, make it really high, because after the bar date passes, they can't increase the claim, but they can always reduce it. And so oftentimes in dealing with a controversy with the state, we say, look, we have three things we can do with your claim. Number one, we can pay it. We're not doing that because you made it up. Number two, we can object to your claim and have the entire issue heard in front of a federal bankruptcy court judge, which, by the way, is a neutral party, not a state court. And all things being considered, normally, all things being equal, the bankruptcy court tends to preserve the estate for the creditors. So we have that going for us. Or three, we can negotiate your claim to number that we can all live with and move on. And, I'll give you an example. I had a claim that we settled last week. That was a $17 million claim. We settled for $400,000. So bankruptcy has its advantages. States don't want to go in front of a federal bankruptcy court judge to explain themselves because the burden of proof shifts to them, right, away from the taxpayer. So there are some advantages to being in bankruptcy. If you know you're heading toward bankruptcy, my advice would be don't settle any pre-petition audits. Don't settle any liabilities. Go to bankruptcy and then work the claims through the bankruptcy process. You'll often get a much better deal with the states. They're willing to deal, willing to bargain, which they otherwise would not be because they know they have their own appeals process backing them up. So bankruptcy, the takeaway, it's not a bad thing, but you need to sort of analyze your attributes going into the bankruptcy. The last thing I'll say is not all bankruptcies are reorganizations. So not all bankruptcies involve the swapping of debt for equity. Some bankruptcies are what we call liquidating Chapter 11s or liquidating bankruptcies, where there's an asset sale, and then the estate's liquidated, and the creditors get what they get. There are some rules in terms of asset sales inside a bankruptcy where some state and local taxes don't apply if it's pursuant to a plan. For example, normally sales and use tax will apply to asset sales inside or outside of bankruptcy. But real estate transfer taxes generally do not apply in a bankruptcy if the asset sales are pursuant to a plan. So it's important for everyone to know that if you're planning an asset sale, if you do it before there's a formal plan in place, you're going to pay real estate transfer tax. If you wait for a plan to be approved, generally you won't pay real estate transfer tax. So there are lots of little subtle nuances to being in a bankruptcy that you need to evaluate. Oftentimes, many times, actual filing date.
Yeah, that's really interesting, and we appreciate it. So we did get a question when we were talking about the aggressiveness of states, and the question was, okay, so we understand that states are getting more aggressive and they're taking positions that may be viewed as questionable at best. But what are you seeing taxpayers do to counteract it? Are taxpayers taking more aggressive positions too to offset the aggressive position that the states are taking, or is there something else that they're doing? So I'll throw that open to y'all as far as what advice would you say? What are we seeing clients do?
Well, I would say almost like two wrongs don't make a right. I don't see clients getting overly aggressive in response to the states being aggressive. I think what clients are doing, again, I wouldn't necessarily call it aggressive, because a lot of what Gina and Maria and I have talked about so far is what's happened over the last 10 years. It's not as well settled. We're not selling shoes or automobiles or dishwashers. We're selling a lot of digital products over the internet, right? And so the traditional rules don't always apply very well to those circumstances. And so the best way to counteract an aggressive state is to be smart ourselves up front and say, we get to set the narrative of how this should be taxed. It's a gray area. It's not completely certain under state rules. Let's analyze it ourselves. Let's come up with a position, and let's document our position so that we're prepared when they become aggressive.
I'll just add to that, Brian, one additional thing, I completely agree, but one additional step to really be proactive is to potentially request a letter ruling, right? So that if you feel like you have a position to take it a different direction, outline your facts, send it to the state, and get it written up. So you're proactive in terms of how you're handling the taxability, and you're not reactive when they come back and assert that it was subject to tax.
That's an interesting point, because you and I have discussed this together several times. And the argument we always have with ourselves is it better to get a ruling? Because yes, if you do, you have certain tax treatment. On the other hand, if by requesting a ruling, are you telling the state, here's an issue for you to look at? And so there's always sort of a break-even point after which, maybe you don't want the state focused on an opportunity to say no in a ruling where maybe we would prevail if it were a controversy. But excellent point.
You still have the ability to sometimes do it anonymously, right? So you don't have to disclose, which would be advantageous. The other side that I would think is tax policy tends to not be audit, right? So, I mean, is it possible that they could communicate? It is, but how likely is it? probably not. And it really depends on the company, right? What is your threshold for risk? Do you want the right answer, or do you want to wait and see how they handle it under audit? It looks like you popped on, Jessica, with maybe your time.
By the way,
yeah, no, I just wanted to give Maria one last opportunity to see if there's anything that she wanted to say as far as clients, and then we'll turn it over to Jessica for her presentation on Answer Connect.
Yeah, thank you. I think the only thing I was going to add is, again, it depends on what the company wants, but I found, at least in the last couple of years, right, is like really having the conversations with the states, and the states would actually be honest with you. I mean, I'll give you an example. For instance, you guys might know that there's South Carolina is really kind of keen on getting a ruling from a court in terms of whether they could forcibly combine companies if there's some type of alleged, kind of shifting of income, and even though South Carolina is a separate company state. And, I would call the appeals group at the South Carolina Department of Revenue when these challenges started happening. I called them and I said, look, is this something you guys would settle, would talk to us, would you reason with us? And they said no. And they said, no, look, our marching orders from the higher ups are that we want a court to opine on this issue. So I would say, in terms of when you're assessing, how aggressive do you want to be? I mean, sometimes, you have to respond to the bullies in a certain way, and you can't be bullied all the way. And if you think you have a really great position, you just have to take a stance. But I do think that having the conversation with the states and understanding exactly where they stand, I think that's sort of helpful in terms of ascertaining, what your plan of action was going to be.
Maria, just editorializing for 2 seconds here. That really is irritating, isn't it? When a state wants a court to tell them they can do that, the legislature can change that law whenever they want. And
exactly.
If they get a court to say they can do it, then they get to pick and choose when they do it, which is absolutely against what should be the rule. But
Agreed.
Well, I appreciate again, Gina, Brian, and Maria for joining me. As promised, I thought it was a highly interesting topic, lots to cover. With that, Jessica, why don't you show us Answer Connect and how we can use it to further refine our analysis?
Sure, absolutely. Thank you. If you just don't mind making me the presenter, I will grab it from here. All right. Thank you. So my name is Jessica, and I work in the Research and Learning Division of Wolters Kluwer. And I want to tell you today about how CCH can help with all of these multi-state challenges that you guys are facing every day. But before I do that, I want to tell you a little bit of background on how CCH Answer Connect came about. About 7 years ago, we were at a crossroads. We had a wonderful tool called IntelliConnect, but we needed to make it better. So we set ourselves to do all kinds of market research. We interviewed over 300 of you guys in the industry. We watched your workflow. We listened to your suggestions and your input, and we decided we needed to create a brand new library from scratch. That's how CCH Answer Connect came about. It's been in the market for 5 years, and the results have been amazing. We've seen incredible year-over-year growth, and we continue to add new customers every day because of how easy it is to use, how fast it gives you answers, and how it really fits within your workflow. We got away from publication based research. You don't have, so as you can see on the screen, you no longer have to make selections. You have to check. Let's take a look here. In going with our topic today, economic nexus, you can see that Answer Connect starts to give me very quick Q&As, and I can pop in and see some answers. It also gives me topic pages, and this is the new way of organizing data. Our editorial staff brings all the information that you need into one place under topic pages. But for showing purposes, let's just do a keyword search for economic nexus. So I know you guys talked a lot today about business income and sales and use tax and how they all come related to each other. So what our editorial staff does is if there is any way to put information in a chart format, they go ahead and do that. They put it in a chart. So you can see my search results give me a multi-state sales tax and a business income tax chart. So let's take a look at how the information is displayed. I didn't put in hardly any details, just economic nexus. And the system quickly gave me a 50-state chart for all jurisdictions. I have some general rules, some commentary. Again, you can see right here, we're referencing Wayfair. I get links to the citation within the state reporters, as well as links to the state reporters. If you want to reconfigure your chart, you can quickly do that by popping up the sidebar so you don't have to start from scratch. You can see right here that you can dig a little bit deeper into the information. So let's take a look at how California handles this particular issue. As we navigate away from the smart chart and into what we call our code page, I want to draw your attention to the top of the page. You can see how we are bringing all information related to this code section into one place. We start pretty high level, right? Explaining what is sales and use tax nexus. We start to give you more details as we go down the page. But across the top, you'll have all of the information that you need. You have statutes, you have regulations, cases, you have forms, you have tools and smart charts. So again, the burden is no longer on you to figure out what you need to look at. And then you can reference back to other states. So one of the best features of Answer Connect has been our integration with Google. I know that a lot of you as partners and decision makers at large corporations, you cringe at the thought of your staff members going to Google for the only source of information. But who can fault them? Google is super easy, right? We've all done it. So what we've done is we created this plugin that allows you to view your CCH Answer Connect results within the Google screen. What this does is it draws your attention into the information that CCH has, and you make the decision from here to route your research into the paid subscription. What does this do for you? It increases usage, it increases ROI for your paid subscription. It mitigates the risk of using unreliable or outdated information. And lastly, we all know when we research, we learn a lot. And we all know these days, it's hard to find qualified staff, retain them, and develop them, right? So when you empower them with this research tool, they'll feel like they're learning and they're developing their skill set. So I hope you like this. Please give us any questions that you may have on the chat. We'll be happy to get back to you. But I hope that you can see how CCH Answer Connect can help you navigate all of these multi-state issues that you and your customers are facing. Please stay on for the last question to confirm your attendance today. Thank you, guys. Back to you.
For the demonstration of CCH Answer Connect, and a thank you to all our fantastic panelists for a great and informative discussion today. This will be the final polling question. The question will remain up as we wrap up today's event. This virtual coffee talk will conclude once the polling question is completed. As a reminder, there will also be a few quick survey questions for you to complete following the webinar. For anybody who answered at least 3 of the required polling questions and stayed connected to the entire webcast, you can expect to receive an email within 2 to 4 business days with instructions on how to access your CPE certificate. Please note the instructions will be sent to the email you used to enroll for today's event. Thank you to all of you for attending our June virtual coffee talk, and we leave that question up for another 30 seconds or so, and this concludes our webinar today. See you next time.